What is up, everybody? Happy Monday morning. Welcome to the Monday Market Update. My name is Sean Grapevine. I'm a branch manager here in Atlanta, Georgia, and I'm joined this Monday, as with every Monday, by the UMortgage all-time lock leaderboard leader. When he speaks, the market moves. He's the Mac of the rate stack, the Baron of Bips, the Titan of the 10-year. His name is Austin Koenig. Welcome, Austin.
Hey, thanks, Sean. Thanks, Sean. Appreciate you taking the time again. And we're kind of counting down the last ones of the 2022 Monday market updates. We're getting to our final couple here.
You know, it's been a long, crazy ride. We've been through a lot together, and we've come out the other side better than ever, I feel like.
That's right. That's right. Getting better.
Nice, man. Well, let's dive right in. Last week was an exciting week with all sorts of stuff, data and decisions. Tell us about what happened last week.
Yeah, so I mean, the highlights of last week, right? It's the Fed having their meeting and decision of hiking rates 50 bips for the Fed funds rate. Essentially, that was very expected across the board. Really, if any drama occurred, it's just kind of interpreting what the Fed said. And we had inflation come out the day before, so I think everyone's fairly well aware. 7.1% is what we had released.
Woo!
Yeah, it was definitely a good number.
Good job, everybody.
And so, obviously, with that being said, like we're having good inflation prints for kind of getting to a number that it looks a lot better at the headline level next year. So right now, things, if they continue to go in the growth, like for example, month over month, it was 0.2%. So
It's nothing. Come on, that's month over month at 0.2. That's year over year, or that's like a annualized 2.4. It's right where we want to be. You're welcome, Jerome.
Yeah, and actually that's exactly right, Sean. And if we do like a 0.2%, for the next months after this, we'll be in the 2% handle of inflation, come the summer. So if we keep things on that track, obviously things look good. But I think where the market had a kind of I guess they had to kind of decide whether they believe the Fed or the data more, or kind of vice versa. Kind of just there's some sort of divergence, right? And the Fed is saying, we expect inflation to continue to stay hot. There's work to do, and they kind of emphasize that we're not done yet here. There's still going to be more hikes, and that's what the market kind of decided. That's not really what we're buying here.
Yeah, is that just a case of like they've been caught with their pants down before, and this is like a case of sort of they're always going to underpromise and overdeliver. Like worst case scenario, they lower rates or stop raising rates too early, and everybody's happy, but they're just never going to get caught in a situation where they're saying like, it's transitory again, right? Like they're going to front run the bad news.
Yeah, if anything, I think it's the Fed is always going to be behind the ape. Like they're going to be behind. They were behind in starting to hike rates and actually trying to fight real inflation. And I think in this case, what we might see is a Fed that needs to see a lot of pain happen before they decide, hey, we're going to ease things up, even regardless of what inflation looks like, maybe. But they kind of need to see, I think, a lot of things in the labor market looking pretty rough is what they want to see, and the numbers don't really show that quite yet. Obviously, anecdotally, we see layoffs coming from Wall Street. We see layoffs coming from tech. The mortgage industry has been hit. I think everyone knows. Companies have been laying off people in the mortgage world. I think it's pretty common knowledge to people even outside the mortgage industry. And so that's one thing, that there are layoffs happening, but there's still a lot of job listings out there. I think it's just the whole labor market participation thing that we're seeing, and what actually occurs. What's the unemployment rate number that we'll see, as we get to further along in 2023? Who knows? But it's probably going to go up, and that's what the Fed almost wants to see. They want to see inflation come down, but I don't think they're willing to give any sort of relief until they kind of see a little bit more progress on both of those factors. And I think that's just kind of the stance they're standing on, and they're not willing to kind of bet and front run and say, hey, you know what, we'll start cutting rates. I think on a
Sure.
pretty good level. No,
Yeah.
they're not going to do that because they already made the mistake of being too slow last time. They might make a mistake of being too slow this time, and going back to maybe a more normal rate. But that's just kind of what we're seeing right now. And you can look at the dot plot that we talked about in the capital markets Q&A last week. It's all over the place for 2024. No one knows. 2023, they're just kind of all standing their ground, saying, "Hey, we're just going to kind of keep it here at around 5 and a
Wow.
quarter."
Wow. It's sadistic, the Feds, hoping for raised unemployment. Well, let me ask you this. I may be getting ahead of myself. This is, maybe a year in advance. But okay, so say they continue to keep raising, right? So there actually is a downside. I mean, from a monetary policy perspective, of continuing to raise the federal funds rate. Obviously, there's a negative side of like, well, yeah, it's combating inflation, but it raises unemployment rates. It increases the cost of borrowing, the cost of credit, and stuff like that. But deflation is a thing, right? Like we rely on a certain amount of inflation to incentivize spending and investment, right? So is there a concern that like they can overcook it and we'll be in a situation like we're like is a deflationary cycle easier or harder to stop? Like, is it a concern? How bad is it? Like, can they raise the rates so much that um that there's actual deflation?
Yeah, that's actually that's definitely a concern, right? That's actually, I think, if you look at a lot of economists that are trying to predict, and that predicting in the world of economics and that sort of stuff is just, it's kind of a tough game. You have to have like these base cases and different cases that for things to happen, but there are scenarios where there could be like that deflationary scenario you're kind of talking about, where we have what they call like stagflation essentially. That could happen, kind of overcooking it to where we're having falling prices, shrinking economy. It's a tough place to be as well. So that's kind of where this like soft landing is a tricky thing to do. I think generally we should hope that we continue to have growth throughout. But what would be tough is we have like an inflationary environment still, but like a shrinking economy, and that's kind of a really tough thing from a monetary policy to really go out and tackle that stagflation stuff. That's really not going to be easy. But yeah, if we have deflation, that won't be ideal either. What we want to as have a normalized price growth that at 2%. That's what they keep on quoting, right? They want to have a normalized unemployment rate. And we kind of were spoiled after the financial crisis of having no real inflation pressure for the longest time.
Mm-hmm.
And it kind of made that monetary policy like it kind of just was not ever worried about inflation. In fact, it was worried that inflation wasn't ever
Right,
coming
right.
back.
I remember
Um,
the reports like like it was in the like under 1% for the longest time, and Fed was like, we need more inflation. Although like they kept saying that, but on the other hand, like we were at historically low inflation levels, and the economy seemed to be zipping right along. So maybe this 2% number is out of date for a healthy economy.
yeah, there's a lot of things that could be considered, antiquated in the world of economics because things change so much. We're so much more of a globalized economy every year, it seems like. So I think everyone can see that just by the Russia and Ukraine war, right, this year. So there's a lot of things to consider, but at the end of the day, what we have to do is we have to listen to the Fed. That's what we have to do. The market does that, but we also look at the market on a daily basis. We don't get talked to by the Fed on a daily basis. And so what the market does is, very important, and it obviously affects our daily pricing, right? So this is, the world we live in, and the market's kind of, calling a little bit of BS with the Fed, but we'll see what happens, in the coming weeks. The next Fed meeting is not until next year, obviously, February 1st. And we'll see, what rate hikes we get, if anything, but hopefully get some more data along the way. And this week we do have some more data, PCE on December 22nd. So that'll be another, big inflation number to take a look at. Is the Fed right that we're going to have a big number there? I don't know. We'll see. If it's anything like CPI, it'll be below what the Fed is thinking.
Okay, so let's talk about some of the effects of these sort of battling pieces of news last week. The 10-year and MBS are pretty much right where they started after rallying a bit, and then it looks like this morning kind of cooling off a little bit, and 10 years right back in the mid 3.5s. MBS are right where they started, and so is that pent up? Is that basically like, we had really good CPI news, we had less good Fed news, and they just split the difference?
Yeah, and a lot of this could just even be different types of flows that are going on. Like maybe equity sold off a lot, so maybe people are kind of doing a more risk on trade today, and it's selling a lot of safe assets. I don't know if that's possibly what the flow is today as well, but those sort of things can kind of happen without data or a Fed talking, for example. It's not uncommon to have like this a little bit of volatility here, but when we've had these huge swings, that's definitely driven by the Fed and some big sort of decision or big piece of data that gets the market really running a certain way. I think a lot of stuff this week could be also attributed to lack of volume.
Sure.
So we see big basis point swings in terms of the yield on the 10-year or how the MBS looks. And that could be attributed to just a lack of players in the market during kind of these holiday weeks.
Right.
And
It's not
yeah,
it's not like the MBS were trading at a super high volume during normal, like over the last couple months to begin with.
exactly. And make even less volume, and it kind of makes moves look even more extreme. But really, when it comes down to it, there's not much conviction behind these. It's just a lack of volume, probably.
Well, okay. So speaking of volume and liquidity in the mortgage market and in fixed income in general, like how our first few months of talking about this, it was basically that was rates were squarely in the sevens, kissing the eights every once in a while, and there were non QM lenders just being shelled out the back, and like it was a disaster for a little while. And we've seen rates come down, we've seen a little bit of normalization. Doesn't sound like there's a ton of volume to support it, but like at least the coupons that we're trading are like exist. How what's the general consensus or feeling in the mortgage backed security traders circle right now? Are people a little calmed down? Are there still significant structural issues?
I think from what I've seen generally, there's a little bit of a. I think everyone's kind of starting to get interested again, but there's not. We're not back to 2021 by any means here. I
Yeah,
think we're
tell me about it.
slightly kind of licking our wins here. I anecdotally have talked to some people that are in the non-QM space this past week that were looking at investing in certain things, and they were talking about how they want to be protected from refis, from like bank statements to conventionals, and looking at kind of how can they kind of keep certain prepayment speeds, like basically how fast these mortgages pay off or refi out, to a certain level. And that's actually something that I've been working on with our team a little bit too, is looking at with the help of Rob Pico getting some color for us. We've been getting some spec pools, looking at that. So spec pools in the agency mortgage-backed security world are where you're actually, instead of getting the just generic pool that gets sent to you, for example, that generic pool, like on a 5.5 coupon or a 5% coupon, the average loan size is about 400K right now, for like a new issued one.
Mhm.
If you look at spec pools, sometimes you buy the ones that are getting the most pay up right now, or the best execution, are the ones that have an average loan size of 110 or below, or 150 and below. The reason
Is
why
that just
those
because
have
there's less prepayment risk on smaller loan amounts?
exactly right, and that's the way you got to look at it. You're looking at a bond that's probably going to take a lot longer to pay off. There's kind of a longer duration there of these loans, staying on the books, because you approach a 100K loan borrower, that dollar amount refi is a lot harder to kind of calculate for them in terms of
Justify.
the break
Yeah,
even point,
sure.
right?
Mhm.
So that's exactly what the secondary market gets too, and they know that the average loan size of 400K, there's prepayment risk there. There's a whole point below where their loans at. they're probably going to want to refi if things make sense.
Interesting. Okay. Interesting. So are we seeing some in the non-QM space, not necessarily the agency space, are we seeing some securitizations actually go through? Are people actually getting, liquid, like near, decent value on their portfolios, or are these non-QM lenders still kind of stuck holding the bag?
I think there's still a little bit of pain in that market. However, I did see one like non-QM bond get marketed out last week. It's kind of the first one I saw in a while. Now I'm not even for sure what the collateral is there, so keep in mind that could even be just old season stuff. But regardless of the case, it's something that they brought to market. I think probably a lot of eyes will be watching, and it's actually kind of strange to see a securitization get sent out this late because of the fact it is the holidays. There's maybe a lot of people that just don't even care or don't look to buy that because of the timing of the year. I think generally it's not a great time to market a new transaction. It'd probably be much better if they did it in January.
I'd be so curious to see what kind of discount they're offering on that. You think it's pretty well discounted and somebody just needed the money, or?
There's a lot of different reasons to sell a bond, right? I think there could be a little bit of that. There could be, I think whoever's on the buyer that side might have a great deal because there's not a lot of bidders on the table. And who knows? Maybe they just shelve it and then try to remarket it later if it doesn't get enough interest or something like that. So there's a lot of different things to consider there. I doubt we see that much more on that side for the rest of the year. I think it'll be interesting to see how that trades if it does, and then going into January, see how that kind of is almost like a comparable or a comp that they can use to trade new things. So I haven't seen anything pricing on that. So once I kind of get some idea there, we can look at how well that does. But
interesting. It's just a personal piece of interest for me. So anyway, guys, we've already gone 20 minutes here, and Austin, I super appreciate your time. Like you said, we've got PCE. Put that in your pipe and smoke it. Coming out this week. Any other big news?
I would say that's the main one to look forward to. I mean, there's always data coming out, but I think PCE is the kind of the headline one we got this week, and I don't think we'll have too much the week after, but I know that's kind of a short holiday week anyway. So yeah, PCE on the 22nd. So that's the one.
Okay, amazing. Well, thanks for your time, guys. We'll see you next Tuesday. Is that right?
Yep.
For the Monday market update on Tuesday. And as always, leave any questions or comments in the comments. We'll get back to you, or Austin will get back to you with specific answers if you have specific questions about the market. Thank you so much for joining us, and we'll see you next week. Have a happy holidays. Thanks, Austin.
Thank you. See you guys.